Hello friends, James Stevenson back with part 17 of my Tesla earnings forecast video review series. I'm joined by my co-host, Loki, who was eating his food a little bit just a second ago. So I'll try and keep this camera trained here in case he decides he wants to eat some more. Hey, he is. He is totally eating. So maybe I'll try and frame this up a little bit better. And you can watch Loki eat while I move on to the content for episode 17. So let's share my desktop. You can keep an eye on Loki and he'll keep eating, I hope. And the next slide in my presentation deck starts off with a bunch of the stuff we just covered. We went all the way down to the non-GAAP earnings as a percent of revenue. Maybe I'll go down to the Automotive Gross Margin excluding regulatory credits line and then call it a day for this video if Loki cooperates and keeps eating his food. Eat your food, buddy. There you go. Keep going. Yes. Good boy. So that's where we left off. I will scroll down the page some, but I'll keep the non-GAAP earnings line at the top of the page so we can reference it. I'll show you what else we have here. So non-GAAP earnings per share diluted is the EPS number. So if you hear people talk about EPS, what's your EPS expectation, what's your EPS forecast, whatever, this is that row. It's row 1235 in my detailed model. And for Q1, I'm expecting $1. And then for future quarters, this number rises sharply in a big hurry. So I've got a total of $7.50 worth of EPS in 2023, which is a lot better than the EPS Tesla earned in 2022, $4.08. Remember, where's my, yeah, so here's the Tesla non-GAAP EPS chart. So this row is the one being charted here. I just mentioned 408 in 2022. Well, in 2021, that number was 226. So it's really rising. You can see from the trend here, it was negative, and then it was nothing, and then it was a lot of growth versus nothing. And then it doubled from there, and then it almost doubled from there. So what's going to happen next? Some people think it'll be $4 again. I think those people are wrong. But what Loki wants is a treat for finishing his food. Good boy, buddy. All right, let's give you a puppy combo. A puppy combo. Yeah, what a treat. What a reward for a little dog. All right, so he'll enjoy that puppy combo in bed. I'll move this camera up so maybe you can get a better look at him. I'll angle this down a little bit. There you go. Got to keep an eye on Loki while you're talking about your non-GAAP EPS. So yeah, $4.08 last year. $7.50 this year. What's doing this? It's everything in my whole forecast model. So we reviewed a couple of videos ago my income statement, and that's most of what's going on here. That's the income statement gets you to GAAP earnings. The only difference between GAAP and non-GAAP is the stock-based compensation. In the previous video, I went through how I'm forecasting the stock-based compensation. So if you were on board with everything I reviewed during those two videos, you're on board with this being the non-GAAP EPS forecast for this year. A lot of people are telling Gary Black that his forecast of $4.80 for 2023 is too high. I don't think that forecast is too high. I think it's too low. I think Tesla's going to sail past $5 pretty easily. Would I be happy enough with $6 or $7? Sure, that's fine. But my forecast has $7.50 in it. Maybe Tesla won't deliver on that, but maybe they will. and then I'll get to be right. It doesn't happen very often, you know. The first rule of forecasting is whatever you forecast, it will be wrong. But we must go on making forecasts, undaunted. The measure of a forecast's worth isn't whether it was right or not. It's going to be wrong. The second rule of forecasting is be less wrong. So figure stuff out as you go along. Get better at forecasting. Try to dial in what you're doing a little bit more accurately. All right, so the next row here gets into a section that I've called PEG ratio over on the left. I gave a little vertical label in some blue highlighted cells over there, calling this the PEG ratio section. So what am I doing? Well, firstly, I have the next 12 months non-GAAP EPS. That's just dragging a box around the quarterly EPS expectations for the 4 quarters that follow that quarter. So we just talked about 750 for the full year 2023. That's the number being shown as next 12 months non-GAAP EPS. And this is the number that I'm forecasting on one of these. Come on. It's got to be one of these. Non-GAAP EPS. I have so many charts, I can't remember which one is where. Too many charts. Yeah, okay, so these, there's that $7.50 right here. So that's my forecast for the full year 2023 because that's the 4 quarters that follow Q4 2022. The 408 is the most recent actuals that we have. That was the full year 2022 as Tesla reported it, full year 2022 being the 4 quarters that followed Q4 2021. Now you see how the x-axis labels work on this one? Okay, so this is what that looks like if you chart it. It's going to get a lot better in a big hurry. This seems like it's ramping up too much when you look at it in this view, but if you go to the next chart over, it doesn't seem so bad on logarithmic scale. If every so often the EPS is doubling, then what I'm forecasting for Tesla to do in the future isn't all that different from what we've seen them do over the past several years. All right, back to the detailed model tab. Just trying to match up what you're seeing in these tables versus what you already saw on the charts as appropriate. So this is what I have forecast for that number going forward into 2024, which is what these are including, right? So year over year non-GAAP EPS increase. What's this doing? It's taking the difference between this number and the one from the year before. Let me click here, which was here. So if Tesla does report $7.50 worth of non-GAAP earnings in 2023, how much more is that than it was in the prior year? Well, the prior year was 408. The 4 quarters that followed Q4 2021 were the 2022 actuals, right? So the increase that I'm forecasting is $3.43 on a base of $4.08. Remember, that's just these 4 cells here. So there's the 408, there's the 750. How much is that 750 relative to the prior year? It's $3.43 more, or 84% year-over-year growth. You take the 750 divided by the 408, and then you subtract 1 from that. That tells you it's an 84% increase year-over-year. That's what these are doing. So I'm forecasting that earnings growth to be more than 100% going forward. Because Q1 isn't that good a quarter. It's actually a little bit of a step back on some of the metrics. Then for PE ratio, what's this doing? Well, the first PE ratio I'm labeling trailing 12-month non-GAAP earnings. So I'm taking row 1204 and dividing by row 1236. Let me scroll back just a little bit so you can find one of these. So here's $4.08. We've been talking about that number. What's the 1204? That is the trailing 6-month average stock price forecast. So I've got a $235 average stock price over the second half of 2022. So that's the denominator. And then in the numerator, I've got that $4.08 worth of non-GAAP EPS. So that's how I'm getting to my PE ratio of 58 for that time period, full year 2022, with the trailing 6-month average stock price as my stock price. There's a lot of different ways you can calculate PE ratio, so I've been intentional about explaining to you how I did that one. Then there's one here that's based on the trailing 12-month GAAP earnings, so that's a bigger PE ratio because the GAAP earnings are smaller than the non-GAAP earnings are after subtracting the non-cash stock-based compensation, which is the more conservative way of evaluating earnings. So that would make it a pricier stock if you were going to base it on the GAAP rather than the non-GAAP earnings. Next, we've got a PE ratio over the next 12 months GAAP earnings. So you can look at it backward-looking or you can look at it forward-looking. How do you want to look at your PE ratios? Well, traditionally, it's easier to find actuals that have been reported in the past than it is to agree on what forecast we're going to use for quarters that haven't happened yet. So mostly people use trailing earnings in their PE ratios. But if you're an investor, do you care about what's happened in the past? You don't. You care about what earnings are coming in the future. That's what you're making your investment decisions based on, right? Is there earnings growth? Are the earnings getting better in the future than they've been in the past? So on that basis, there's a PE of 34 looking at the next 12 months GAAP earnings. So let me scroll up here and you can see what that's doing. It's just taking my GAAP EPS for full year 2023 here and dividing that by this trailing 6-month average stock price of $235. So the price divided by the earnings is 34 in that case. That's a more down-to-earth PE ratio for any company, but especially for a company that's growing earnings more than 100%. That's looking pretty cheap. Not trading advice, for entertainment purposes only, do your own research, etc. Then there's a PEG ratio here, which is taking the last 12 months PE divided by the next 12 months growth rate. What are we doing here? We are looking at this 58 and we're looking at this 84% earnings growth rate that we talked about just a minute ago. All right, so you take that amount on row 1238, the earnings growth rate of 84%, multiply it by 100 to convert it from 84%, which is 0.84, to the number 84. And then you're dividing the PE ratio into that 84. So you're taking the 58 over the 84, and it's giving you a 0.68 PEG ratio, pretty low, which is, and it's staying low in my forecast for the future. So a number below 1 is a stock to consider buying if you believe that Peter Lynch knew what he was doing investing based on earnings growth. He would look at how much he expected the earnings to grow by and then make a price target accordingly. So Peter Lynch's price target at a 0.68 and a $235 stock price, he would say, hey, you ought to feel good buying that stock anywhere below $343. And then as the earnings continue to grow and this multiple remains favorable, it remains less than 1, that price target continues to rise. So you'd be comfortable buying Tesla below 545 or 656 or 773 or 904 in these future quarters. And I already went through all the disclaimers. So these are not guarantees. This is not fueling my forecast model. It's not changing what I'm forecasting. These are just for fun, these rows here. They're not, nothing depends on these rows. They're just here for entertainment purposes. That's why they're here. Then there's a 12-month price target, historic PEG ratio adjusted. What am I doing here? Well, I'm taking this 750 expectation for non-GAAP EPS for 2023. That's on row 1236. Multiplying that by 100 to call it 750, and then multiplying that by the average PEG ratio over the trailing 4 quarters prior to this one. So the PEG ratio had been above 1 for a big portion of 2022, right? So there's your 12-month price target if you held to the historic PEG ratio. So if you said, hey, these historic PEG ratios are better, they're closer to where where I would expect Tesla to be trading. Well, if you think that's going to happen again, if you think these numbers are going to rise above 1, then that's your price target. And then I've got Stevenson indicator here, which is the most technical analysis I ever do. This is a joke. I've got a whole playlist explaining what Stevenson indicator is. It ended 2022 at $420.69. Not really, but I like to kid people. Actually, really close. $420.67 is really where it was. But yeah, that's just a little joke, technical analysis thing that will rise to 563 by the end of 2023. So for anyone who cares where Stevenson indicator is going to be by the end of 2023, that's where, $563. And then I've brought back in my GAAP net income again. This is just linked up to the top of the page to do a little reconciliation from GAAP net income to adjusted EBITDA. How do you walk from one of those numbers to the other? Well, you add back interest expense. You add back the provision for income taxes because you want to see the number before income taxes and depreciation. So you add the depreciation back. That's another non-cash expense. Depreciation is on assets that you already own. You've already paid for them. You didn't have any expense during that quarter that was cash expense associated with that depreciation, right? And then the stock-based compensation expense gets added back. And that's how you get from GAAP net income to adjusted EBITDA. You just add up all those rows, and that's how you do it, giving you an adjusted EBITDA margin if you divide this into the revenue, the total revenue at the top, including all the divisions. 22.2% back in Q4. I have that dropping again about 4 points, 4.2 percentage points, 4.20 percentage points from 22.2 to 18.0. And then hopping right back up again in Q2 and improving from there in Q3 and Q4. For the same reasons I mentioned, the income would get better and the gross margin, etc. Automotive gross margin, I've got falling more than 5 points here from 25.9 to 20.1, with only 1 point being contributed by regulatory credits as a percent of revenue. That number was higher every quarter in the previous 4 quarters, so we've got a pretty low regulatory credits forecast every quarter this year, so maybe Tesla will sell more than this many regulatory credits. But if you dock those off the total automotive gross margin percent, that leaves you with Automotive gross margin, excluding regulatory credits, of 19.1%. That's the one that's down about 5 points sequentially from Q4. Remember, that number was already down from Q3. Some of the December delivery incentive promotions in the US are baked into that. And then some of the price cuts that happened in China already in Q4 are part of that sequential decrease from 26.7 to 24.3. So 19.1 is a lot lower than the 30% that it was the year earlier. I mean, that's going to look bad to be down 11 points year over year on the automotive gross margin, excluding regulatory credits. But the important thing to remember there is it's not going to stay that low. I mean, Tesla Q is going to be on Twitter right away as soon as this number gets reported, saying it's over, call it, Tesla's going bankrupt now. They're just going to keep losing 11 points year over year every quarter until they file for bankruptcy. Well, no. This is going to be the worst quarter for automotive gross margin, excluding regulatory credits, and then it'll get better with Shanghai, Berlin, and Austin all producing more vehicles in these future quarters than they will in Q1 at improved cost per vehicle sold relative to Fremont. So that favorable mix is going to improve automotive gross margin, excluding regulatory credits, and that's where I will end this video. So, as promised, there's Loki enjoying a nice nap after his breakfast and his treat. And with that, I will end the video by saying if you've enjoyed today's video, you could leave me a comment and let me know, hey, enjoyed the video, good work, Loki, or good work, James, whatever you want to say. That's free to do that, or to click the like button, no charge. But if you haven't subscribed to my channel already, you can do that over here and click the notification bell if you want to be alerted when I post fresh videos. And thank you to everybody who supports me either through Patreon, where you can get early access to my videos the day I record them, or by joining my YouTube channel, as Kathy Kitchler and Halter Ferguson Financial did at the executive producer tier. And I'll see you in the next one.